The time, I think my watch is not working properly. I think I got started late from my building. It took me some time to get here. Okay, and as you know, briefly, I think the course is supposed to be on algorithmic trading and quantitative strategies. So this is the course I started developing here at Stanford in 2010. The first few years have been pretty rough, and the last few years have been pretty okay. I think, thanks to help from people like Leo, who have been very good TAs for this course. So briefly, let me go through what about myself and few things that you should know for this course. And how many of you do trading on your own? Algorithmic trading. So what kind of algorithms do you use?
Right now, no.
No.
That's fine.
How do you trade? How do you decide to trade?
Fundamental basis.
Fundamental basis. Okay. Any other? Yeah.
I don't have many complicated algorithms, just some naive logics, and I think my basic strategy will be momentum trading. Find some signals and rank, give each stock some score, something like that.
Okay. Any other ideas? Yeah.
We can use the technical analysis like the moving average, like MACD and KDJ.
Okay. Any other ideas? Okay. So algorithms have always been around for a long time, but with electronic trading now, it has become even more important to put certain algorithms in place because trading occurs so fast. At the high frequency trading, we are talking about millisecond tradings, and if you look at the limit order book, you will see that orders come in and leave at a very fast pace. Okay, why they leave at a fast pace? It's something that one has to look into, mainly because lots of orders come in just to test out the market, to see where the market is, and then they decide whether they want to stay in the book or they want to leave. Okay, and all these decisions are made pretty fast. So it's very important that certain algorithms, so that there is no big loss that can occur if you make a wrong decision, you need to have those algorithms in place. As I mentioned before, algorithms have been around for a very long time. People use some kind of algorithm in mind, fundamental principles, or some sort of momentum. I think those are the main ideas that we are going to talk about in the class. Okay. Now, I think with computing power is so cheap and so easy to use, you will see that we are not only going to look at one stock at a time, we are going to look at multiple stocks at a time. Okay, we can also look at stocks and bonds and stocks and options, stocks and futures, and so on. For this particular class, I am going to focus mainly on stocks. Equities is going to be the focus. If any of you are interested in extending these ideas to bonds, extending these ideas to options, I think there is a lot of scope. Not much is done, mainly because options are traded not as often as the stocks are traded, so it is a slow trading. Still, I think there is room for using some sort of algorithms there. So we'll cover some of those things later. Okay, so I got my PhD from University of Wisconsin-Madison in 1983, and I've been teaching. I taught in Wisconsin system for 15 years before I moved to Syracuse. My specialty is multiple time series modeling. That's where I started, and I've been coming to Stanford since 2005. Almost, I think I was a full-time visitor for 2 years. Then I've been coming every summer here. Okay. I also worked at Yahoo. I was the forecasting lead for them, and I was with IBM Almaden Lab for 1 year. I was also with Microsoft Research Lab here, I think, which got closed down last year. So I don't have the opportunity to visit them here anymore. Okay. So I have not given any office hours, but I plan to be here every day until 2 o'clock. Right, 1 hour before the classes start, I'll be here, and I should be, after the class, I should be here until 2 o'clock. So feel free to come and ask me any questions if you have. Okay. And I also want to introduce Leo Packless. I think, Leo, you want to say something about yourself? Or
Sure. Yeah. Hi guys, I'm Leo.
I'm right now a fifth year, I believe, in the PhD department at Stanford, doing my research on not totally related to algorithmic trading, but multiple hypothesis testing. So when you want to test many things at once. And yeah, I'm your guys' TA, so no office hours set yet. I think there'll be roughly 1 to 2 hours a week, and we'll set those up soon. Yeah.
And we also have a grader for this course, Licky Wang. I think you will keep an. Oh, Licky is here too.
Hello.
Thank you. Yeah. And he's he'll be grading the assignments and other things. Okay. And as far as the course description is concerned, you will see that there are roughly about 4 modules that I want to cover. The first module is going to be mostly on looking at time series methods. And it's very important that if you have not done any time series class, you better take a few moments to read through some books. And the book I would recommend is by Say, T-S-A-Y. That's a nice book to read. It's on financial modeling, something that you would like to know. And Say and I were classmates, and we go back and forth on comparing our notes. So I know the book fairly well. And the second part of the course is going to be on technical analysis. I think mostly looking at trading strategies that people use in practice. And I think I'm going to cover, they're all going to be based upon the time series method that you are going to pick up in the first part of the course. Okay, that is the second part of the course is going to be on roughly technical analysis. And there we will cover not only trading one stock, but also trading multiple stocks. Okay, so there is a strategy that people use in practice. It's called pairs trading. How many of you know pairs trading? So the idea behind pairs trading is that if 2 stocks are by nature expected to move together, and whenever there is a deviation from that, you should be able to exploit that deviation. Okay, and the company long-term capital management was supposed to have specialized in that. Okay, so we'll cover all that in the technical analysis. And the third part of it is going to be on execution algorithms. Okay, with high frequency trading, you can decide when to enter the market, but when to enter the market could be done in many different ways, mainly because in US we have, I think, roughly 16 lit venues. What I mean by lit venues is that the venues where you can go in and see what the order book is, who is posting, not who is, where the orders are posted, in which side of the book it's posted. And there is also dark pools where you don't know anything about. Okay, so when you have 16 venues, you have to decide to which venue you want to send your order to. Okay, so execution algorithms have become very important now, mainly because of cost of trading has gone up, and you want to reduce the cost. How do you reduce the cost? There are direct costs that are such as brokerage cost and execution fees and so on, rebates. Those things are all fixed. There is also what we call as market impact cost. What is market impact? After you enter the market, how the prices are likely to move against you. Okay, especially if the other side knows, if your supplier, the other demand side knows that there's enough supply here, they can lower the price as much as they can, right? So this price movement has to be studied carefully. That is known as market impact models. So we'll cover that execution algorithms as a third part. The last part is going to be on some sort of portfolio analysis. If you want to combine stocks and bonds and among several stocks, how do you come up with an algorithm that can take into account the features of several assets together? That's going to be the focus. Okay. And as far as the last part is concerned, I think the last week of classes, I am not likely to be here. I'll be attending a conference. I'll try to rearrange those 2 classes beforehand so that we'll cover the entire gamut that I mentioned here. Okay. I also have a long list of reading list here. So one of the things I did when I prepared this reading list was to make sure that I bring articles from mainstream finance here. Okay, if you look at the research done in algorithmic trading, they can come from mainstream finance or they can also come from quantitative finance. Okay, quantitative finance tend to be mostly developing models and executing the models, whereas mainstream finance gives you a little bit more economics focus, which is very important for you to understand, because that's where the fundamental principles came from. So I'm trying to combine those two here, and also I've given a long list of optional texts. As I mentioned before, I think the Say's book on time series is very important. And if you want to read a little bit about how the trading and exchanges take place, I would definitely recommend Larry Harris' book. It's a nice book to read. And other book that I would definitely ask you to look at would be the book by Easley and DePrada and O'Hara. This just came out 2 years back. This is on high frequency trading. This is an edited book. Okay, so if you can go through those 3 books, I think you should be fairly in good shape. All the other books on the algorithmic trading are, we'll cover most of it in the class. I don't think you have to worry about it. Okay, and if you want to understand how the market microstructure works, you have to look at Hasbrook's paper. Okay, so can someone tell me what is market microstructure? Why do you have to worry about it? Okay.
I'm sorry.
So market microstructure is nothing but how the actual trading takes place. Okay. So how the players come into the market and what kind of things they look for and when they leave the market. So all those things are given as a market microstructure analysis. Okay. And one of the key statistics we are going to look at when it comes to market microstructure is using the high frequency data to see how frequently the trading occurs and how the trading intensity alters the prices and what kind of information you can gain from price dynamics and so on. Okay, so those are the main things we are going to focus in the class. Okay, so if you go through the reading list here, I think I want to mention that focus only on the articles that I put an asterisk around. I think those are important papers. For instance, if you want to read stylist facts, I think Ramakant's paper, 2001 paper, pretty much the standard paper to look at. When it comes to market microstructure, you should look at Madhavan's paper, and so those are the papers I would read. As we go along, I think I would also briefly mention what things you need to focus on as we do that. Okay, so grades are going to be based on mainly assignments and final project. And as far as the assignments are concerned, there will be 3 assignments, each consisting of several problems. And assignments can be done on a team basis. I would like to keep it 2 or less. That's a team I'm going to keep. And we are going to use mainly R, which is available now. I think Leo is going to give a demo on Wednesday on R. So how many of you are familiar with R? Okay, I think there are some last year who had difficulty with R, so we are going to have some demo on Wednesday. Okay, and I think the project is going to play a very important role. Okay, the reason why I assign a project is that you have the ownership of your own ideas, so you can apply the techniques that you learn from this class on a data set, on a new problem that you want to look at. And in order to make sure that the project that you take is of reasonable quality, I would like you to submit a proposal. I think I mentioned here by Monday, July 27th. So the idea being that I don't want you to repeat an exercise type problem. Okay, you don't take the assignment problem and repeat it on a different data set. But I want you to think about something new, something original. But at the same time, I don't want you to get bogged down with too much of a difficult problem too. I want you to be careful about it. So I would like to submit 1-page proposal so that I can make sure that the work you do is of some quality. Okay. So those are the main things I wanted to cover here. Any questions? Yeah.
Are the articles and texts available online? Do you know if we can find most of them?
Text must be available on the library. I'm not sure, but articles should be available. All the articles are published articles, so you should be able to get them. Okay. Yeah.
Excuse me, would you mind to repeat once again about the textbook name?
No, it's all textbooks are optional texts, right?
Yeah.
You don't need them.
Like before you introduce technical analysis, the second part, in the first part, you mentioned that there is a textbook that we can read about.
For the technical analysis? Oh, no. For technical analysis, there are few books that are mentioned here, and most of those ideas that in the technical analysis I will cover in the class, these are sort of spread all over the place. If you look at Loy and Singh book, there is a chapter in that book that talks about algorithmic algorithms that are used. And the book I think people use in practice is this by Edwards, Maggie and Bessetti book. And many of them are not rigorous books. These are all sort of from practitioner's point of view. Okay, I would suggest that just wait until we cover them in the class, and then if you want to read more, I can give you other ideas. Okay, any other question? Yeah.
Are you going to need the textbooks mentioned in the bookstore, which are Quantitative Trading with R by Jorga Kapoulis and Statistical Models and Methods for Financial Markets by Lyons?
What's that? I can't hear you.
There were two textbooks
Yeah.
that are in the bookstore, Stanford
Yeah.
bookstore. So, are we going to actually need those books, or is that list of textbooks the only required materials?
Yeah, I think I mentioned, took out two books that I gave you in the list. I think, most likely you don't need them. I will cover them in the class. So you don't buy them. The edited book by, I think, Eastley and DiPrado, it's a pretty good book to have. But I also noticed that the topics are all scattered all over the place. So I will cover some of them in the class, so you don't have to worry about them. Okay. Any other question? Okay. I also want to mention that why this is popping up. I also want to mention that we are going to have 3 speakers come into the class, and we're going to have a speaker from JP Morgan Chase, and we'll also have a speaker from BlackRock. Anant Madhavan, who wrote the microstructure paper, is going to be here. And there is also a speaker who was a former Goldman Sachs partner, so he is going to be here too. So these practitioners, after the practitioners would give a talk, and I plan to take them out for lunch after that. If any of you wants to join them to ask questions, you're most welcome to do that. Okay. Okay. Any questions on the syllabus itself? Any? Yeah.
Can you talk about the assignments?
So the assignments are going to be roughly about 5 or 6 problems. Okay. And either I'm not sure why this is popping up. Assignments are going to be 5 or 6 questions, and they would involve fairly large data sets and be very structured. We'll ask you to do certain things, like for instance, when it comes to first assignments, mostly it's going to be on time series modeling. So you should know how to fit, autoregressive models and things like that. And then you should know how to make inference and what to make out of this data sets. Okay. So I would expect that, I'm not sure how much time will it take, probably about 15-20 hours it should take. Yeah. And I think it's some problems are going to be more involved than others, but generally it should take about 20 hours. Any other question here? Okay, let's get started. So this week I think the focus is going to be on time series models for modeling the mean and modeling the variance. Okay. When I say modeling the mean, what exactly I mean by modeling the mean? So we are going to look at few items that I want you to keep in mind. So we are going to model the stock price or asset prices over time and see if there is any trend in the data. Okay. One of the key quantities we talked about was momentum strategy. Momentum strategy says that if the prices are going up, they're likely to go up further, right? So we should invest in it. The second strategy I think we are going to see is the contrarian strategy. What is the contrarian strategy? The prices have reached certain low, maybe we should buy because the prices will bounce back. Okay, so depending upon what point of view you have to go for one or the other, but you can combine them in some fashion too. You can decide that in some cases you want to use contrarian, some cases you want to use momentum strategy. Okay, so a few symbols that I want you to keep in mind are the following. So I'll keep back and forth between the black whiteboard and board. Okay, so let me write here. P of T is the price of a stock. Okay, and so we know that return is supposed to be P of T minus P of T minus 1 over P of T minus 1. So that is the return, right? Return, okay. So models for P of T is going to be looking at average expected value of P of T. See, whatever you models you have, this is going to be models for mean. Okay. So the average price could depend upon number of other factors. So you want to model that. And we also going to use variance of P of T. What exactly variance of P of T give you? What is the variance of P of T give you? When the prices are bouncing back and forth, that shows that that particular stock is a little bit uncertain, right? There's a little bit of riskiness involved. So usually I think variance of P of T is supposed to measure some sort of riskiness in the asset. Okay, so we are going to model the mean, model the variance. Okay, so there is some attempt now even to model the higher moments like third moment, fourth moment, and so on. They don't seem to have direct relevance to finance area, but it on their own I think might provide some information. Okay, so variance of P of T, we are going to look at models for variance. Okay. So one of the things we are going to look at later on would be that when the company announces its earnings statement, that is supposed to provide some information about the future performance of this company, right? Usually you would see that there is a lot of uncertainty around that time, and if you compute the variance around that time, you will see that that variance is slightly higher than the variance otherwise. Okay, so there are lots of event related studies that we are going to see how the variance affects it. Okay, so let me start here. Before I get on this, we're also going to see one part of it which I did not mention here, was to relate the news information to stock performance. Okay, the news type of information to stock performance. For instance, we are going to look at data from Twitter. So whatever keywords that are being used in the Twitter, all that information is going to be aggregated, and we are going to outline based on that information. We are going to we are going to say whether it's a positive news about the stock or negative news about the stock, and we are going to relate that news to the actual performance. Okay, so there is a company called iCentium. There's several companies, but iCentium is one that I have access to some data, so I'm going to show you that information here. Okay, so I think these are, as I go along, I think I'm trying to incorporate new piece of information into the models. Okay. So algorithmic trading, as I mentioned before, there are three components to it. How much to trade, okay? How much to trade depends upon if you are a noise trader. Noise trader means that, traders who want to liquidate their position for whatever reason, right? So you have to decide how much you want to dispose. But if you are a portfolio manager, you are likely to rebalance the portfolio every so often, every 3 months, roughly. At that point, you have to decide which stocks you want to get rid of, which stocks you want to buy. So you need to decide how much to trade. That depends upon your rebalancing strategy. Okay, so that is the first question, I think. And the second question is when to trade. Okay, when to trade would generally means that when to enter the market and when to exit the market. Okay, so when to enter the market, I think we already talked about few strategies here. You also have to decide when to exit the market. Okay, what kind of decisions, what kind of data, or what kind of information you need to decide when to exit the market? Anyone? There are a number of things you can do. After you reach a certain profit level, you can say that you want to quit, right? That's one option. The second option is that after you enter the market, it's possible that the market is not going in your favor, it's going against you. So you need to decide that enough is enough, you want to get out of the market. Okay, so you need to put some stop loss arrangements to get out. Okay, there's so many different ways you can decide. Okay, and the last part of it is the most important one: how to trade. Okay, so this is where I think the execution algorithms come into play. What I mean by execution algorithms is that you need to decide to which exchange you want to send your order to. Okay, and now I'm looking at level 3 data where I have information, timestamped information on all the orders that gets placed. There I can see that multiple orders are being submitted to various exchanges. One order gets executed in one exchange, immediately all the other orders get cancelled. Okay, so people are playing in all these games, sending orders to various places and so on. So you have to decide how to trade. Okay, before I get to this, I think I want to mention that there are two types of orders we are going to look at. One is market order, and the other is called limit order. Okay, what is a market order? So this is a decision I think the traders have to make: limit versus market order. What is the difference? Anyone? What? Yeah.
A market order is where you buy or sell the stock at market price.
Right. Market order is that, I want to buy or sell certain number of units, get me the best price, right? That's a market order. What is limit order?
Is a limit order if it hits a certain price, then you buy or sell it?
So you decide, what is the price you want, how many units you want to sell, you post it. Depending upon what kind of price you post, either you are going to be close to the best price or, away from the best price. So if you post a price that is not even close to the best price, your order is likely to sit in the book for a long time. Okay, so that's one thing that you have to know. Okay, so a couple of things I want to mention here. I think just broadly, I think you need to decide whether you want to go for limit order versus market order. Okay. There is also another issue that one has to know. This is that Suppose you have a large number of units that you want to buy or sell. Let's assume that this is X is the size of the parent order. Size of the parent order. Okay. So if you go to the market with a large size, maybe part of this order you can get the best price, but if you want to buy more of that, you have to go deep down the book, which means that you have to pay a higher price. Okay. So what people do here is that instead of going to the market with a large number of large sized order, they decide to split this X into smaller units and send it to the market. Okay. So if you have this size of the parent order, you need to divide this into n child orders. Okay. So which means that you have to take this X and divide this into x1, x2, etc. up to x of n, so that all these x's add up to the total size that you want to dispose. Okay, that's what you should do. Okay, how do you decide this x's, capital X into small x's? If a particular stock has very low volatility, what I mean by low volatility is that prices don't change much, right? Then you can divide this X into equal parts and send it to the market, right? But if a particular stock has high volatility, which means the prices are likely to change faster, how would you divide this capital X? You want to trade as soon as possible, right? So those are the two main ideas people use in practice. Okay, I spent 1 year at JP Morgan Chase trading desk. I think we tried to come up with some alternative ideas for trading, differently. I think this basic strategy still remains the same. We try to use some combination of these two at various depending upon what the market condition is. Okay, so those are the ideas that I want to mention. How much to trade, when to trade. Although it's easier said than done, you have to decide when to enter and when to exit, and how to trade. I think these are the three important components that we are going to see, and all these things are possible because easy access to historical and real-time market data, and the computational speed has increased, so you can do all these things almost in real time. Okay, so as far as the algorithms are concerned, I think we are going to look at order book, execution data, and level 3 messaging data. So how many of you are familiar with the order book data? Okay, so we will have access to some information from campus. I'll try to get you that information. Level 3 data, I have some sample data which I will post it here. Okay, what is the difference between level 1, level 2 and level 3 data? Okay, so the basic difference is as follows. Okay, so if you look at the order book, it's going to say that, okay, so this is say there are 100 units available for $1, and then say I'm just going to make up some numbers here. So 50 units for 2 and 40 for 1 or 4, etc. Okay, so that is the ask side. Okay, on the bid side, possible that there are somebody wants to buy 200 units and they want to pay only 99 cents, and then there is somebody else who wants to buy 100 units for say 97 cents, etc. Okay, so this is the ask side and this is the bid size. Okay, you can see that if the difference between the best bid and best ask is called bid-ask spread. Okay, so that spread is always going to exist unless someone wants to cross the spread and make the market order. Okay, so this is how the limit order book looks, and in the actual real data you will see that this book doesn't stay stable for more than fraction of a millisecond. It changes very fast. People come and go. Okay, and the difference between the best bid and best ask is the bid-ask spread, and sometimes people look at the mid spread, and you have to cross the mid spread at least to get the other side. Okay, so level 1 data, if you look at it, they post only the best bid and best ask. Okay, level 2 data, you look at first 5 positions and on both sides. Level 3 data gives you all the positions. It also gives you information on which order is cancelled and how long this particular order stays in the book. So you have an ID number which you can track over time. That's the main idea behind level 3 data. Okay, and so this is the order book for one exchange. Okay, same order book exists for multiple exchanges. Okay, you'll see that. Okay, same, this is for exchange 1, this is for exchange 2, and so on. Okay, so for instance, if you look at Microsoft, its main exchange is NASDAQ, right, 50%, and then rest of them are sold in various other places like New York Stock Exchange and BATS, ARCA, and so many other exchanges. It gets sold. Okay, but I think each exchange has this. There is a rule called Regulated National Market System. It's called Regnomics. I think that's a rule that covers sort of all the exchanges together. Okay, what it says is that if you send a market order to any exchange, you are supposed to get best of the prices in all the exchanges. Okay, so that is the rule that sort of governs this all the exchanges together. It's called, I think, a Regulated National Market System. Okay. Still, I think it's not quite optimal because, for instance, if you have, suppose you convert this 200 orders, right, into market order. Okay. If that is the case, you can see that the first 100 orders you'll get cheaper price, right? The next 100 order is going to be, next 50 orders is going to be at the higher price, right? So anytime you convert the market order with large number of quantities, you have to go deep down the book to make it happen. Okay, which means that it's going to be more expensive. Okay, suppose assume that in the second one you get dollar here. I'm just going to make up some numbers here. Okay. And let's assume that the second exchange has, say, 50 units and they can sell it for $1. Okay. So when you convert this into a market order, if you look at these two exchanges, the best price is coming from exchange 1. So it's going to get 100 units from this exchange. Next 100 units, it's not going to look around and optimize over exchanges. It's going to execute in the same exchange. Okay, so although Regnomics is good, it's good only for the first available units that you can cash in. If you go beyond that, I think it's going to execute in the same exchange, so you may not get the best price for the entire quantity that you have in mind. Okay, so keep that in mind. That's still some issue with that. Okay, so I think how to trade has become as important part here. So as far as this course is concerned, we are going to focus mainly on looking at statistical analysis of price and returns data, and based on this we are going to identify trading opportunities, and we decide on the execution strategies based on that, and then we always going to measure against certain benchmarks. Okay, what are the good benchmarks that you will measure against? SP 500. So are you beating the market, right? So that's one way to look at any other benchmark. Yeah.
Just absolute return.
Absolute return. Okay. How do you get that? Absolute return means that just buy and hold. Are you referring to that, or?
No, just don't look at any benchmark. Just look at your performance.
Right. That's going to be the return on the strategy, right? So there are two or three things I would tend to look at. One is this S&P 500. Are you as good as the market, right? And the second one I would look at would be risk-free return, right? And the third is buy and hold. You don't have to do anything, just buy, keep the thing. Are you beating that, right? If the particular stock price is going up, generally what kind of strategy you need? You don't need any strategy, right? You can leave it there, it's going to go up, right? So those are the few ideas that we need to look at. Okay? So we'll talk about order management and routing. Routing is the given a certain size, which exchange you want to send it. So many of these investment banks now have smart order routing algorithms. So essentially they look at where the demand is, where the supply is. Depending upon which side they are on, they will decide where to send the order to. Okay? And then I think market impact models, this is the area where I've done some research, and then we'll also talk about portfolio approach. Okay? So I think this is pretty much what I've said before. Okay? So the simple strategy people mention is that buy low, sell high. Sure, how do we do that? Okay? So there are two approaches that we are going to see. Prices tend to have a momentum. They tend to trend. So that is called the momentum strategy. Prices have a tendency to mean revert. That's called contrarian strategy. Okay? And I want to mention that when it comes to momentum, we are going to look at individual stock momentum, but in finance, they usually make it as a portfolio of momentum. What they do is that they take all the stocks together, look at the past performance, and divide the stocks into 10 deciles, and they take the money out of the lowest decile and put the money in the top decile. Generally, the stocks in the top decile tend to perform better than any other group. Okay? So when it comes to momentum, just keep in mind that we are going to look at two types of momentum. One is the time series momentum, the other is the cross-sectional momentum. So most of the mainstream finance literature talks about cross-sectional momentum. That is that your group of stocks in the top deciles, how they do into the future. Okay. So to begin with, I think we are going to look at one instrument, and you'll see that technical rules are very much used in foreign exchange. So this one place where you see, yeah.
Do these two strategies always contradict each other?
They contradict in the sense that you need to decide based on your feeling where the market is going. Okay, there is contradiction. Yes, yeah. In fact, I think I just taught a group of students from China about 3 weeks back, and they tend to use the momentum strategy more than contrarian strategy. And they were talking about the psychology of Chinese investors, how it works, and so on. Okay, so it depends on the market, though. Is where you are. Okay, so we are going to look at initially one instrument. Okay, then we are going to look at the two instruments where we are going to look at pairs trading and so on. Okay, one thing I want to mention here is that the literature mainly talks about two instruments, pairs trading. But you can extend that two to several instruments together. Okay, and one of the key techniques we are going to use in the class is the concept of co-integration. Okay, concept of co-integration. So anyone know what co-integration is? Yeah.
Do variables or instruments go in the same direction with each other?
Right. If two stock prices are moving together, right, by taking a proper difference between the two, you should be able to make this difference to be stationary. Okay. So what is the idea behind stationarity? Stationarity is that the series is supposed to move around an average, right? So whenever it deviates from the average too much, you make a transaction, the idea is it will come back to the average. Okay. So one of the key concepts that we are going to learn from this class is that stationarity is an important concept. Okay. And co-integration is nothing but making two non-stationary series stationary. Okay. So that's the idea here. You'll generally see that price series tend to be non-stationary. Okay. So there is also, I think, index arbitrage, linear combination of prices and so on. And here we are going to look at ETFs. What are ETFs? ETFs are exchange traded funds, right? They're like mini portfolios. So essentially they construct one stock which is a combination of the stocks, right? So depending upon how much risk you want to take, you can decide whether to buy individual stocks, whether you want to buy this combination stock. Okay. So generally the combination stock, the ETFs tend to have lower variance than any of the individual stocks. So that's one of the reasons, less risks, people go for that. Okay. It's also possible that, if some stocks tend to pick up price very quickly, ETFs are going to be slow to catch up. Okay, because it's only a fraction of the stocks are invested from that stock. So there are pros and cons of this ETFs. Okay. So in order to motivate this, I'm going to define this problem as a forecasting or prediction problem. Okay. So you have to know where the market is going. Essentially, you have to know where the prices are going, right? So the first set of rules are going to be technical rules. I want to briefly mention what exactly I mean by the price series. So we are going to look at n assets at the same time, and then we are going to look at the factors that go with them. Okay. So when we say factors, we mean market factor. Okay. Generally, if the market is going up, you should see the stocks generally also pick up. If you are going to be investing in the top 500 stocks, they will definitely are going to go up. Okay. One is the market factor. The other is the industry factor that we are going to look at. For instance, now we know the oil prices are down because the entire oil industry is not, prices are going down. So that's something we're going to look at. We also look at the volume and volatility associated with these prices. Okay. So what is the idea behind using volume? Why volume is important? Yeah.
Because illiquid stocks, in order to sell them, perhaps you have to sell them at a lower price because there is no buyer.
Right, but what I think, this one is selling for liquidity reasons, right? You want to sell. Why do prices change?
Depends on demand and supply of the stock.
Demand and supply, right? If you look at it, prices are supposed to change only if there is true information about the stock, right? But if you look at some stocks, for instance, I think recently somebody mentioned that Citigroup at one particular day, the prices changed 6,000 times. I'm just going back and forth. Okay, so those changes come mainly because of market friction, right? The demand and supply friction. Okay, those changes tend to be fairly marginal changes. The big changes are supposed to be coming when there is true information about the price. Okay, so so I think the volume was considered to be a proxy for information. If there is heavy trading that occurs, that means that people have some information about the stock that others don't have, so that provides volume as a proxy for information. Okay. What about volatility? Why is that important? So you can show that there is a connection between volume and volatility if there is information about the stock. And if there is no information, those two quantities are supposed to be independent, right? So by looking at, take a duration of data, look at the volume volatility connection. If there is a connection, that means that there is some information, okay? So the information is something not directly measurable. So you have to infer that thing from other values like volume and volatility and so on, okay? So we are going to look at first the technical rules. Technical rules are nothing but predicting the price based on the past prices. In addition, you want to use the volume. In addition, you want to use the volatility. Those are the information that goes in technical rules, okay? So the first part of the course, we are going to use only the past prices. So that's where I think the rules, moving average and all those things come into play. Then I would slowly bring in volume information and volatility information to see if they add any value to the technical rules, okay? The second part of it is going to be the momentum. Momentum, as I mentioned, is going to be, in this course, I'm going to cover mostly cross-sectional momentum. So take a group of stocks and put the money where the best performance stocks are, okay? And the last one is the fair value model, okay? Does anyone know what exactly I mean by fair value model? What is a fair value model, okay? So this goes back to a simple calculation people use, simple model that started with the CAPM model, okay? What is a CAPM model?
Based on market value risk.
Market value. It's capital asset pricing model. So essentially what it says is that excess return that you make, excess of risk-free return, it doesn't come easy. You have to pay a price for it. So it has to do with the market excess return. How much price you want to pay depends upon how correlated the returns are with the market return, okay? So if you look at the CAPM model, I think the fair value model comes from there, okay? So roughly, before I go further, I think I have a slide later, but let me give you this. So I have written that return is equal to change in price over the base price. So for this particular course, I would like you to think about P of t is equal to natural log of capital P of t and I'm going to write this return R of t is equal to change in the natural log of P of t minus log of P of t minus 1, okay. I want you to get used to writing the return in this fashion because it has some simple nice properties, okay. So what exactly this means? This means that difference in the log is going to be ratio of this t minus 1. So if you add 1 and subtract 1 and add 1, so from here you can see this is going to be log of 1 plus P of t minus P of t minus 1 divided by P of t minus 1. It's going to be log of 1 plus RT. If RT is small, generally you should see this is equal to RT. Okay. So this is an indirect way of computing the return, okay. The nice thing about this is that you can see if you want to get the return for, cumulative return is fairly easy to calculate. For instance, suppose I have return on the second period RT is equal to log of P2 minus log of P1 and say R3 is log of P3 minus log of P2. So if you want to get the cumulative return, you can see R2 plus R3 is log of P3 minus log of P1. So this kind of calculations are easy to compute if we have, for cumulative return calculations, it's easy to use the log prices than prices. Okay, so we'll follow this format for this particular class. I think it's easy. Whenever you take log, I think it's also easy to use calculus kind of concepts here. So what exactly is the fair value model? Okay, fair value model says that R of t minus R of f. So this is the risk-free return. This is equal to alpha plus beta times market return RMT minus RF. Okay, I just put a T on both of them, RFT plus epsilon T. Okay. So this is exactly the capital asset pricing models. Essentially what it says is that excess return here is related to excess market return, and the beta is supposed to be the measure of riskiness of this particular asset. Okay, so what exactly is alpha? If CAPM hypothesis is true, then you should expect alpha to be 0. Okay, and you'll see that alpha to be 0. Okay, so you'll see that some of the investment bankers boasting about alpha strategies, essentially what they are saying is that even after you adjust for the riskiness of the asset, still there is excess return they make. Alpha is positive. Okay, so that's what so this is what I'm going to call it as a fair value model. Okay, it's one of the fair value models. You can have additional factors. There is something called Fama and French factors. We can add it here, and you can use that Fama and French factors to have additional factors. CAPM model doesn't always fully explain the variation. Still, there is a lot of variation left here. It's not, R squared is never going to be 100%. It's always going to be some difference. So that's one of the reasons why they add additional factors to improve the model. Okay, so when they talk about fair value model, essentially you have certain economic theory in mind. You want to see whether how the returns are related to market return and other factors. Whatever is excess, that's what we are going to call it as fair value model. Okay, so so we'll get to some of these things later. We go along. Okay. So this is how the trading data actually looks. Okay, how does the trading data look? So let's assume the market is open from 9:30 to 4. Okay, and the trading can occur at any point in time. Not only trading, the arrival and cancellation of all orders can occur at any point in time. Just to briefly illustrate here, I have taken only the trade execution data here. T1, T2, T3 are sometimes called tick data. Okay, essentially that's when the actual transactions take place. Okay, as you can see, they are not going to occur on a regular intervals, right? It can happen any time in the time. So data usually comes at irregular intervals. Okay, and the quantities associated with are called marks. And for that reason, this is sometimes known as marked point processes. Okay, these marks could include what is the price that transaction gets executed, how many units are being bought or sold, right? It also can indicate the status of the order book. Okay, when I say status of the order book, one of the key quantities people look at is imbalance in the order book. You know, the more suppliers than demand or more demand than supply, you know, you look at that imbalance of the order book. Okay, so I think, you know, if you start aggregating this information into smaller time intervals, what can happen? As you know that some stocks are traded almost every millisecond. Okay, I was looking at Cisco data. I think almost every 4 or 5 milliseconds there is something going on there. Okay, some stocks are traded, you know, rarely, sparsely, right? So if you start aggregating them into time units, what will happen? Suppose I try to aggregate this into every 5-minute interval, right? So I can say that what is the average price in that 5 minutes, how many transactions have occurred, and so on, right? So one way to summarize is that if we put them into discrete time units, then we can use all the time series techniques that we are going to learn directly on that data. Okay, but the actual data is not going to fall exactly into that time bins. Okay, if you start putting them in time bins, it's possible that some time bins may not have any information, no transaction occurs, right? So there is going to be some loss of information, but this data as it stands, it's very noisy to analyze. Okay, so that's the reason why we want to go for some sort of time binned information. Okay, so we'll talk about optimal binning and so on as we go along. Okay, so we are going to move from point processes to discrete time series. Okay, so here I think I want to briefly mention that the most detailed analysis is the point processes, point process data. Okay, and from here you go to discrete time series. So when it comes to discrete time series, I think, you know, there is also this idea of low frequency data. So when I say low frequency, what I mean by that is usually people tend to look at daily data as a low frequency data. Okay, you can look at the daily closing price, see what is the volume that gets traded during that day. Okay, and you can also get price bar information, like what was the open price, what was the closing price, what was the high price, and what was the low price. Okay, but in some setup, I think they sort of go through low frequency. I'm going to say daily. Okay. Somewhere here you will see that some compromise is being made. Here people look at price bars. Okay, and I've seen this data is commonly used, 30-minute data. Okay, so essentially you aggregate the data for every 30 minutes so that there is always some transaction that's taking place in the 30 minutes, and sort of a compromise between looking at very detailed point process data and then this is crudely aggregated data. Somewhere in between you can look at it. So the price bars generally tend to have open price, high, low, and closing price for that particular 30 minutes. Okay, so you can see that sort of intermediate between these two steps, and people tend to use this information. This is supposed to provide a little bit more detail than aggregating all the data into one full day interval. Okay, so these are the things you can do. You can divide this day into k time units. For each period you can compute the number of transactions that take place, average price. There is also volume weighted average price. Volume weighted average price is that in that particular interval, how many units are sold, what is the price, you get the weighted average of that. Okay, you can also look at the average duration within that interval. If we take 5-minute interval, how frequently the the trades occur. Okay. So going back to this particular data here, trading data, one key quantity people look at is the duration between successive transactions. Okay. Why is that important? When I say duration between successive transaction, I mean T2 minus T1, T3 minus T2, and so on. Okay. Why is that important? If those durations are very small, that indicates that there is either market friction, right? People are going back and forth, or there is some information about the stock that's coming in. Okay, the duration is fairly large. That indicates that there is not much information about the stock. Okay, so when it comes to high frequency data, you would see that duration plays an important role. Okay. So today I think the focus is going to be on looking at time series. Okay. How many of you have taken a course on time series methodology? Okay. So I will take the view that if you have done regression, you probably can do auto regression, right? And moving average is sort of a little different from auto regression, but all moving average processes can be approximated by auto regression. So I would suggest that if you know regression well, you should be able to do auto regression fairly easily. Okay, so for any stochastic process, there is a mean function, there is a variance function, and there is the autocovariance function. Okay, and what is autocovariance function actually tell you? So the dependence of current observation on the past observation, right? That's what the autocovariance gives you. Okay, and from there you can compute this autocorrelation function. Autocorrelation function is nothing but covariance function divided by the two variances, two standard deviations that we have, sigma t and sigma s. Okay, all these things are not going to be possible to compute because you have only one realization of the data, right? Yt is the only one number you observe at t. Okay, so there is no variance of t, right? So this more practical definition is here. So stationarity is the most important concept that you have to know. Okay, for today's lecture probably that's the main thing. So the average is supposed to be a constant, and covariance term is given by gamma h. Essentially the main idea here is that the distance between two observations in terms of time unit is the only thing that matters. It does not matter where you are, okay, which t you are in. The difference between t and t minus h is supposed to be the only thing that matters, gamma h, and the correlation, autocorrelation is given by rho of h, given by that quantity gamma h over gamma 0. Okay, so the main idea I think is that a stationary process can never go too far away from its mean. If it goes away too far, it's supposed to come back to where it's supposed to be. Okay, so that's a concept we are going to repeatedly use in technical analysis. Okay, how do you do that? Okay, so the speed of mean reversion, how fast it comes back, depends upon gamma h. Okay, okay, what is the difference between regression and auto-regression given this structure? That's something I want you to think about before you come to the class next time. I'll tell you the key difference between regression and auto-regression next time. Okay? Any question you have? Yeah. Okay. Yeah.
Can you use SAS for the modeling?
SAS?
Yeah.
SAS or?
Yeah.
Yeah, you can use it. Yeah. But I think R would be better because Leo is pretty good in R, so he can, if you get into some issues, he can help you. I am familiar with SAS, I can help you too, but I think, any questions you have? I'll stop here. If you have any questions, let me know, okay? Thank you.